Good evening. This is Mitch Firestone from Precision Trading Labs in New York City, and I just want to give you a quick rundown on a nice trade, an options trade specifically, a credit spread that was just done the last few days on Humana. If anybody's been keeping track of healthcare stocks, they've had a nice run-up. At least a number of them have had a nice run-up since the election, as the thought that the Affordable Care Act might get rescinded and other things going on. So at any rate, Humana was one of those that had a nice run-up. And here's a chart that I was looking at on a weekly, and I had established this level here where I expected, in fact, after this huge run-up, that Humana, in fact, would be stretched, oversold, and, in fact, at this level, there would be a sell-off here. So, at any rate, that was the initial price action thesis that I had on this setup. And what I just decided to do was, rather than to short it, I would express this trade by using options. In order to figure out what strategy I actually would want to use, I did a quick assessment and analysis of the volatility environment. By doing that, basically this is my scan of various options that various symbols that I use for options. I like things that are liquid. I like things that have sufficient volume in terms of both their in terms of the volumes of options traded, as well as open interest. In looking at the volatility environment for Humana, I noticed that its relative volatility over the last 12 months, in fact, was quite high. This IV percentile that I have in my scan here basically measures, gives a relative indication of where volatility is, where 0 is its absolute low, 100 is its absolute high. So this is not its actual implied volatility, but in fact what it is that it's a measure of its relative volatility versus the volatility every day for the last 12 months. And you can see this is just under 90%, which essentially means that it's really quite, the volatility is quite inflated. It's quite high in relation to where it is at other times of the year. In circumstances like that, rather than me buying puts or calls or even doing debit spreads, I would much rather be the house, because at this point, under these circumstances, options are very expensive. And so at that point, I would rather be paid to play rather than having to pay to play. So in this case, I'm happy to be the house, I'm happy to be the casino, and so in fact I would like very much to collect premium rather than to pay for options. So that was my decision here, that in fact I would do some sort of credit spread. And so what I just simply did was opted to look at and do a bear call spread. Again, this was my level where I expected price to roll over at some point. And so what I did was set the anchor of my bear call spread at 220. I did some analysis and looking at the theta in terms of the time decay, how much delta I would get, and basically played with the strike prices until I found something that would meet my criteria. So I came up with a couple of different scenarios. One that was going to expire in a little over 2 weeks. All of this analysis, in fact, was done on the 1st of December. So this was, excuse me, last Wednesday or Thursday. So this option would have a little over 2 weeks to go. This option would have a little over 5 weeks to go. In doing the analysis, here was the theoreticals that I was looking at here. And I did a little quick analysis. I kind of looked at and saw I had roughly identical delta here. But in fact, on the shorter duration, not surprisingly, the theta was going to be much greater here. And in fact, also Vega, which in fact is your enemy in a credit spread, because obviously you do not want to see volatility explode on you, because that'll make your spread more expensive. And of course, that's the enemy of your position when you're selling. So being able to reduce Vega a bit between these two was a good thing. So all other things being equal, in doing this assessment, I made the decision that I would in fact get into the shorter duration trade, where I was going to be collecting approximately 380 or 390 in credit, rather than going for the longer duration trade where I'd be collecting about a little over $7 of credit. And in fact, one can also see, just on a very simple-minded basis, that you're basically in if you look at this trade where you're in for 50 days versus this trade where you're in for a max of 15, you're basically in for over 200% more time, and yet you're only collecting about 75% more premium. So just on that very simple-minded basis, you can kind of see that this in fact was a better trade. All the Greeks worked out. The risk reward that I was looking at in terms of looking at the various time slices seemed to work out just as good or better. And essentially what this meant was that I would be collecting effectively more money on a daily basis, and there's less time for things to go wrong in the trade, because I'm only in this trade for a max of 15 days versus basically being in here for let's say 10 days short of about 2 months. So at any rate, that was kind of the just the initial scenario here. When I actually got into the trade, in fact, you could see that on last Friday, it spiked into the zone. It started to go against the scenario, but then as of today, it actually dropped out of this level nicely. And you can see right here, it drops down to, at the time that I took this time slice, it was basically right down near this time slice, which was essentially roughly the first target in terms of where price was going to go. When I did that, in fact, the price of the option had moved from about 380 or 390, and you could see right around this time, right here, this time slice, this was done around 208. This was in fact a little less than probably about $1.40 or $1.50. So in the space of about 3 or 4 days, the value of this option had declined from about 380 or 390 down to about $1.40. So that's obviously an over about a 60% move in the first 4 or 5 days, and so that was a real nice move to start this trade off. So at any rate, in short, that's kind of a very brief synopsis of this trade. Again, starting out with a price action thesis where one can expect price to turn at some point, doing an analysis of the volatility environment, then actually doing and structuring the trade in terms of setting up a spread where you're getting the proper level of delta, a desired level of theta, and then shielding yourself from an increase in volatility as indicated by Vega. So at any rate, that's what I got here. Again, this is Mitch Firestone from Precision Trading Labs in New York City. Please reach out to us with any questions. Up here is our email address and our website, and I will see you next time. Take care. Bye-bye.